Hello, Stephen Cruz here with MyMortgageBroker.com and Paragon Mortgages. Today, what I wanted to do is talk a little bit about reverse mortgages in Canada. And before we do that, let's make sure that you press the subscribe button down below and register to get more of our videos. We provide videos on mortgage financing and financing related topics for Canadians to help you when you have decisions to make about your financing and other aspects of that. So smash the like button if you think this video is fantastic. And what I'll do is I will share my screen here in the moment. Okay, so we are going to talk a little bit about reverse mortgages in Canada, and is a reverse mortgage a bad idea? And so before we do that, what I'd like to do is review a few different aspects of reverse mortgages before I actually discuss whether or not it's a bad idea. So what is a reverse mortgage? We'll talk about that. How does a reverse mortgage work? Who qualifies? When do I pay the mortgage back? And is a reverse mortgage a bad idea? I'm also going to give a couple of client examples related to that. So let's just talk about what a reverse mortgage is. Reverse mortgages basically are just like normal mortgages, except you don't make any payments. You set up a mortgage on your house, get some money out, or do it on a purchase, and you don't have to ever make payments again. You have the option to make payments if you want, but the interest on the mortgage just accrues on the mortgage, so the balance goes up instead of going down. It's a way to get access to equity in your home, and you can do it either through one single payment, and many people think of doing a reverse mortgage when they need to get equity out of their house, but you can also do it as a purchase. Or they can do multiple payments, and that's how they were originally designed long ago, is that you've built up all this equity in your house and you want to be able to draw some of that equity out without having to sell your house. The only way to get equity out of your house is, well, there's only two ways really. You either set up, you sell it, this is the first way, or you set up a mortgage of some sort. And the reverse mortgage can provide you with multiple payments. So you can get a lump sum payment out initially, and then you can get $1,000 or $2,000 or whatever a month for X amount of months until you've used up the amount that you were approved for. And interest on a reverse mortgage is accrued, as I said before, to the end, to the top of the balance. And so the balance will grow instead of going down like a traditional mortgage does. How does a reverse mortgage work? Well, the amount that you would be approved for is based upon your age and also based upon the value of your home. And the minimum age you can qualify for a reverse mortgage is age 55. And typically the amount of money you're going to get, or equity you're going to get out of your house, is going to be closer to 25% of the value of your house. And then the older you get, the larger percentage you can get access to with respect to your house. If you were going to do one lump sum draw on a reverse mortgage, the minimum amount is $25,000. Most people set them up for a lot more than that, but that is the minimum amount. And if you want to do multiple withdrawals, they still require an initial draw of $25,000, and then you can do withdrawals of $5,000 or more at a time. They'll allow you to do $1,000 a month, or $1,200 or $1,500 or whatever you want. So that is also possible. So who qualifies for a reverse mortgage? Pretty much anyone qualifies. It's not considered an A mortgage or a prime mortgage. I've talked about A mortgages in my my blog on my website, and I talk a little bit about A mortgages, B mortgages, alternate lenders and stuff. And this is more of an alternate lender. You have to have you have to be a minimum age of 55 to qualify. So I said pretty much anyone qualifies. Really, anyone ages 55 and older will qualify. It does not matter your credit score. Doesn't matter what your income is. It only matters how much the home is worth, your home is worth, and your age. And those are the two factors that are used to determine what amount of reverse mortgage you can actually get. And one of the advantages, two of the main advantages of these reverse mortgages is that your income doesn't matter. So if you're retired and you don't have a lot of income, that doesn't matter. And if you've had some bruised credit for one reason or another, that also doesn't matter. So those are some advantages for getting a reverse mortgage. So the other question I get from people is, so how do I pay it back? Do I have to pay it back? How does that work? And basically, you get to choose how you want to pay a reverse mortgage back. You can either sell your home, and if you're because the lender is using your home as collateral, when you sell your home, you no longer own that collateral, so they must be paid out from the sale of your house. And so if you sold your house, you have to pay it back. If you moved from your house, so if you moved into another residence or you needed extended care or whatever, and you moved from your house, then you would be required to sell or pay off the mortgage. They do give you time to do that. It's not instantaneously, but you want to make some arrangements to either sell your house or to pay off that mortgage, reverse mortgage, if you were to move to another property. And you can also, which people don't realize, you can also make payments to the reverse mortgage. So you could pay down some of the interest that has been accrued. So, and you're allowed to do that every year. They will allow you to do it. Most clients don't do it, but it is certainly possible. And if you come into some money, or if you wanted to extend the life of the reverse mortgage, you can do that, or if you wanted to get access to more, but most people don't use that. One of the things in Canada that makes it is different for reverse mortgages here versus in the US, for example, is that the companies that provide reverse mortgages here will guarantee that as long as you live in your home, if they approved you up front, as long as you remain in your home, you keep the home, you maintain the home, then they will not force you to move or sell or make payments on the reverse mortgage. So as long as you live there, you can do that. They do talk about property taxes and keeping the property taxes up to date, but both lenders will allow you to take advantage of the provincial tax. There's some provincial tax programs, I guess I could call them, provincial tax programs where you don't have to pay property taxes. And each province is slightly different. So you'd have to go and check in the province for your own province. And I have and I'll put the link in the description below, but I have an article that talks about reverse mortgages on my website. And in there, I detail the different provinces and the programs that are available for property taxes. And so if you want to help ease your cash flow and you don't want to pay your property taxes, most provinces will allow you to defer them until you sell your home. And most of the time there's an interest cost to that, but it's not onerous. And there are advantages to you and your cash flow to do that. So both reverse mortgage lenders in Canada will allow you to do that. So basically you could defer your property taxes and just maintain your home in good standing and have your home forever as long as you live. Is a reverse mortgage a bad idea? All right, so that's really the topic that we're talking about here. I wanted to make sure we're both on the same page before I start talking a little bit about whether or not it's a good idea or a bad idea. And for me, I think it depends on every individual situation. So kind of a cop-out answer maybe, but every client is different. And for some clients, a reverse mortgage is a great idea. For some clients, it is not. It's not a good idea. And what I thought I would do is just detail a little bit about that and why it may or may not be a good idea, and then talk about some client examples, and then you get a better idea of what it might work for you. If you do, or if you are considering a reverse mortgage, then connect with us or connect with a mortgage broker who specializes in reverse mortgages. I would not recommend that you connect directly with the companies that offer it. They're biased, and they're going to tell you why it's a great idea. And I have access to reverse mortgages. I have access to lines of credit. I have access to mortgages. I have access to private lenders. I have access to all sorts of different products. And we can together look and see which one is best for you, instead of going to one provider and deciding this is what you think is good, but they're not telling you about anything else. So I think it's important, whether you speak with me or whether you speak with another mortgage broker who has access to other lenders, including the reverse mortgage lenders, then that's what I highly recommend. So one of the advantages of a reverse mortgage is that it does not affect your government pension. Because you're drawing the money out of your house, you're drawing the money out of the equity in your house, you're not drawing an income. So it doesn't affect your income, so it won't affect your benefits. And I've had clients who've taken some money, invested, and then their income from the investments are over a certain limit, and then they lose the GIS. And so if you're worried about potentially losing some benefits that you're receiving, then the reverse mortgage is not going to do that unless you invest all the money into something that generates a really good return that you have to file in your tax return. So that if you do that, then it may, sometimes that's a better return than getting the GIS supplement. So that's something you'd want to talk to with your financial advisor. Another reason to decide if it's not a good idea is if you actually qualify. So if you qualify for a traditional mortgage, or if you qualify for a home equity line of credit, then a reverse mortgage might be a bad idea. And you want to look at those two things and see if those are beneficial or not. It's always been my philosophy that if you're going to take financing, you want to be in a better financial situation or moving towards a better financial situation when you do the financing. You don't want to put yourself in a worse financial situation. And so having a reverse mortgage could be and could put you in a better financial position, but it may not. And a traditional mortgage may. And so it's important to look at those two, especially if you qualify. Reverse mortgages have less criteria to qualify for. And when you have a traditional mortgage or a home equity line of credit, the key is you're going to make payments on that. So I've had clients who were retired, they set up a home equity line of credit, and they didn't need all the money, and then they used some of the limit to draw an income. And so in the beginning, they were just drawing a little bit out of the line of credit, and so the interest cost was very small. And so, they would draw out $1,000 a month or something like that to keep their cash flow going so that they could survive. And after a few years, now they've accumulated 30, 40, 50,000, and now the interest is starting to grow and add up, right? So now they're not just drawing out the $1,000 a month to live on, they're drawing out the $1,000 plus another $500 or $600 for interest, 4, 5, 6, depends on how much they owe. And so then the limits quickly starts to or the balance escalates and gets closer and closer to the limit. And so in that case, once they get to that stage where they don't have much equity left or much room left in their line of credit limit, then it might be better for them to move to a reverse mortgage. And I've seen clients do that. So set up a home equity line of credit, and they use it for the funds they needed to a certain point, and then they pay that out with a reverse mortgage. And that put them in a better position, and it let them to draw out more money over time than they would have been able to with the reverse mortgage. And so that was an advantage for them at the time. And it was a bad idea initially, it became a good idea later. So that is how it works. So let's talk a little bit about a client who used a reverse mortgage to purchase a house. So these clients, a couple, husband and wife, he's age 75, she's 76, and they owned a home. They owned their family home and sold it 5 years ago. So 5 years ago, they sold their family home, and they sold it for about $650,000, and they invested the money. What their plan was, and so instead of getting a reverse mortgage, instead of getting a line of credit, they thought, we're just going to take the money and we're going to invest that and live on the interest, the return they were getting. Their financial advisor was good and got them a good return, and they've rented for the last 5 years. The downside to renting is that they had to move several times. Unluckily, they moved into a house or condo apartment, I think, and the landlord decided to sell. So they lived in this place for a year, and then they had to move. And It was kind of annoying, but they found another place and lived there for 3 years, and they had to sell again. And so, or the landlord sold, and so they had to move again. And they were kind of annoyed because they thought, well, you just wanted to stay in one place. We like this place. We want to stay here. None of this. So they moved one more time. And just this summer, the landlord decided to sell again. So they were getting tired of moving because they had less control over where they were and where they lived and stuff. So they decided, you know what, we're just going to buy a house, and then it could be our house, and then we don't have to worry. But they didn't really want to use up all their investments. They'd been drawing an income from their investments, I think $2,000, $2,500 plus their OAS and CPP, and they didn't want to eat into that because that was part of their living expenses, and they understood that they won't be paying rent per se if they purchased the house free and clear, so they wouldn't need to draw as much out, but they'd be stuck again with all this equity in the house. And so when their financial advisor recommended they chat with me, I talked to them about two options. I talked to them about a reverse mortgage, and I also talked to them about a home equity line of credit. And so they ended up deciding to go with the reverse mortgage. They found a little bungalow, and they had been looking at condos. They were looking at smaller houses, and they decided to find a little bungalow that was further away from the city center, actually closer to where their kids live, grandkids and stuff. So they found this nice little bungalow for $400,000, and they decided to put half of the money, half of the purchase price, $200,000 down. So that would still leave them with around $450,000 of invested assets, so they don't have to cash in all their assets. And then they set up a reverse mortgage, and that helped them because now they didn't have to pay rent. They did pay some property taxes and some other stuff. And this little bungalow actually could have a suite in it. So they thought that potentially if they wanted to down the road, they could put a suite in to help supplement their income if they needed to, but they weren't going to do that this time. And so this helped them with their cash flow, and they also didn't have to draw as much income from their investments as they were before because they were paying rent. And so if I compare this to setting up a HELOC, and we did this comparison at the time when we were looking at the options. And so the HELOC, it would have been a $200,000 line of credit as well. It would have had interest-only payments, so that would be $750 a month. And so it's less than the rent they would have been paying, but there's also, property taxes and other things. So it would have worked out a little bit more. Rent was a little bit more, but anyway. So with their OAS, they were drawing $2,250 a month for their renting and housing costs and other stuff. And if they had set up the HELOC, then they would have to just draw $2,000, which would be more money than they wanted to, based upon reducing their investment amount by the $200,000. So when they looked at the numbers with the reverse mortgage, they didn't have to draw as much from their investments. They only had to draw $1,250. So that was the winner for them. And that's why they decided to choose the reverse mortgage instead of setting up the home equity line of credit. And they could, if they want to, pay extra funds to pay off the interest if they want, but they weren't planning on doing that. They have some family. Most of their kids have 3 kids. Most of their kids live in the US. 2 of their kids live in the US. 1 of their kids lives in Calgary, where I live. And they decided to move closer, like I said, to where their daughter and grandkids are. So the kids didn't want, their money. They wanted their parents to be happy, and so they chose to do the reverse mortgage instead, and that was a benefit for them. So let me look at one other client situation. So this is on a purchase. Not everyone realizes reverse mortgages are available for purchases. So this is a more traditional situation. And this is a reverse mortgage for debt consolidation. I had another couple who were actually called me out of the blue for a second opinion. And they found me online, and they are another couple, age 74. He's 74 and she was 73. They had a house worth around $500,000. They had a first mortgage of $175,000, and the mortgage payments were around $1,500 a month. So it was going to be paid off in less than 25 years, but it was still big payments, right? Fairly big payments. And they also had some credit card debt, and they told me that they had a situation with their son that happened. That he really needed some money, and so they gave him some of their savings and to help him out, and then some other things happened, and they drew down credit cards to cover some of these other things that happened. So the payments in all of these are now starting to get to a point where they're late on their payments, and they're struggling with making all of these payments that they've got, and so their credit's gotten a little bruised. They had spoken with another broker, and that broker was looking, or offered a second mortgage to them. The second mortgage was not, it's going to ease their cash flow, but it's not at favorable interest rates. The interest rates are over 12%. There's fees, costs for setting this up. And so for the $50,000, the fees were all legal fees, appraisal fees, all that stuff was going to end up costing them, $6,000 or $7,000. So it was not a cheap option, and they called me just to get an opinion about what their situation was and how they could salvage this. Whenever I talk to clients, I usually like to review all the options. So there is the first option: sell your house. If you sell your house, then you're going to be able to pay off all this debt, and then you're going to have, in this case, $250,000 left over after real estate fees and this and that. You'll have quite a bit of money. They really, really like their home, and there's lots of memories there. They weren't ready to sell yet. They knew that this is something they were planning to do in the next 5 to 7 years, but that's not what they wanted to do right now. And so I talked about reverse mortgages instead. So we looked at a situation for them, and they qualified for $225,000. The advantage to the reverse mortgage for them, instead of a second mortgage, is that there would be no payments. In fact, the reverse mortgage was pay out the existing mortgage. It would pay out all the credit card debt, so there'd be enough to pay out mortgage and credit card debt, and then they would have no payments. So that increased their cash flow by $2,700. Now, that they were struggling to make the $2,700, in fact, not making the $2,700. So I really can't say it increased their cash flow by that much, but they are now in a situation where they have freed up the stress. They're not feeling as stressed as they were before. They now can build up that reserve and that emergency fund that they had before that they used up, and they can stay in their own home, which is what they really ultimately wanted. And so this reverse mortgage was a much better option than looking at a second mortgage with payments in $600. So it would reduce the overall payments for them a little bit, but it wouldn't reduce them by $2,700. They would be paying $2,100 a month, which is probably close to what they could really generate. And for these clients, this was a much better option, and that's what we ended up doing, is setting up this reverse mortgage. And the relief that they had once they did that was just crazy. I also had another client who called and who had a house that was worth several $1 million, and they had a first mortgage and a second mortgage and a third mortgage. Now, this client would have qualified for a reverse mortgage, but because they took out the first and the second and the third, there wasn't enough equity in the home to set up a reverse mortgage. And so I wasn't able to help them. And the best recommendation I could have was for them to sell their house. But if you know someone who is retired and who might be struggling because things have happened, and then they need some extra cash and they're thinking about a second mortgage, please have them look at other options, because a second mortgage, as much as it could form an initial solution, it might be the best solution, there is also the option of setting up a reverse mortgage. And so many people forget about that option and don't consider it. And so it's really important, if you have options available, please look at them all, and then you can make the best possible decision for you. So if you think this information was valuable, please smash that like button, press the subscribe below. I am Steve with MyMortgageBroker.com. I love to provide this information about financing and mortgage financing and other related things. And until next time, have a fantastic day.